Hello, my name is Simon Kay from Lopian Gross Barnet, and I'm here to talk to you about the changes to directors' loan taxation following proposed draft legislation, which is anticipated to become full and final legislation in the next few months. There has always been a tax charge on companies who lend money to directors, and this applies to close companies, typically those with 5 or fewer shareholders. And the tax charge applies where a director's loan account is overdrawn 9 months after the year end. And where that's the case, there's a 25% tax charge. Now, that tax charge is repayable in the event that the loan is repaid in future years, but it still can represent quite a significant cash flow burden for companies who are affected by it. Now, what many businesses have done is pay out a dividend or a bonus to the relevant director on which they pay income tax so that they can then settle the loan balance. And that's absolutely fine, that's fairly common practice. But the government became aware that there were people who weren't using these normal mechanisms of a dividend or a bonus and were finding other ways and means to enable the individuals to settle the loan balance, and typically for it to be reloaned again a short while later, thereby getting around the 25% tax charge. So they've proposed some draft legislation which they intend to counteract that, and I'll tell you a little bit about how that works. What I would say is that whilst we're focusing on the tax charge in the companies, it's important not to forget that there is a potential income tax charge under the benefit in kind rules on the director, if depending on the quantum of that loan, which I'll mention at the very end. And that there is also a potential income tax charge if the loan is eventually written off, but more on that afterwards. So, what does the draft legislation propose to do? Well, the first thing is that previously loans made by a company to a partnership were treated as loans directly to the partners, and they were caught by this tax known as a Section 455 tax. However, the government and HMRC by concession had said that they wouldn't apply that where a company which was a member of a partnership was loaning money to the partnership. But HMRC feel that position is now being abused, and the draft legislation means that that will no longer be the case. So companies lending to a partnership in which they are a member will now be caught by the tax. Secondly, certain people were using structures where they loaned money to intermediaries, which got them around the wording of the legislation, which only covered loans to a relevant person. But the government, again as part of the draft legislation, have sought to deal with that, and now loans to certain types through hybrid partnerships, and particularly to trustees, will now also be caught. Thirdly, businesses sought to use the fact that the old legislation, referred to loans and advances of money, and therefore they tried to come up with arrangements whereby the funds that were passed to the directors weren't a loan or an advance. And the new legislation that's been proposed makes much wider reference to benefits conferred on a participator, and that's extremely important because it's a very wide definition, and therefore will catch a lot more things. And the final thing, and possibly the most complex, relates to what the government term bed and breakfasting. Now, this is, as I mentioned earlier, where a loan would be outstanding, the loan would be resettled, and then a short period later, the funds would be reloaned. Well, the government have caught on to this, and they've proposed some specific provisions depending on whether the loan is between 5 and 15,000 or more than 15,000. And effectively this will catch things where those amounts are overdrawn, the loan is repaid and then reloaned within 30 days. However, more than that, there's actually a separate provision which covers situations where even if the loan isn't repaid within 30 days, there was an intention during that 30 days to reloan the monies subsequent to that 30-day period. And as you can see, that is extremely wide, and it's yet to be seen how that will be assessed by the government. Now, it's just important to close by saying that this legislation is still draft, and we wait to see how things might change when the final legislation is issued. However, people should expect significant scrutiny of this area from HMRC. And finally, it's also worth adding that not everything is bad news. So firstly, these proposed arrangements will not catch situations where companies pay a dividend or bonus to the director from which they resettle their balance, because at the end of the day they are suffering income tax on that dividend or bonus, and the governments are happy with that. And finally, I mentioned the benefit in kind tax charge. I want to bring to your attention that the previous threshold of 5,000, below which there was no benefit in kind tax charge, has now doubled to £10,000, which should represent some good news for the directors themselves. Thank you very much. I hope you found it useful, and hope to speak to you again soon.